Hello, this is Dr. Paul Cottrell, and I'm going to be talking about the economy in this video. For the ones that don't know, we had an eventful week, all right, with data and also Fed announcement. And then, of course, what's been happening in Israel and the oil market and whatnot. But the two big economic data points were the Federal Reserve announcement where they were not going to cut. They just held their rate at 5.25 to 5.5%. And they signaled that there might be a cut in September. Okay. I've been hearing in the news, the ones that are pricing in different cuts from the Federal Reserve, that there are going to be two or three in the year since this announcement. I think that's a little aggressive, but who knows? We'll have to see. And then the other data point that came out was that the unemployment rate used to be at 3.8 and it went up to 4.3%. Now, there are a couple things that we need to keep in mind here. Inflation, not the rate, but the absolute cost of goods like groceries, housing, that is very difficult for many people in the United States, even with an inflation number of 2 or 3%. So we have to be able to slowly grow into this kind of inflationary period to be able to absorb this price shock. So when you keep on hearing from typically the Democrats right now, but whoever is in office, they'll say, well, the inflation rate is, near 2%, which is the targeted rate for the Federal Reserve. There's some debate on maybe raising that rate to 3% or 2.5%, but there's a discussion to maybe raise the rate. But my take is that just keep it at 2% as the target, and that inflation rate should be running a little bit below that target to be able to have the economy grow into the 2 years of mega inflation that we've had under the Biden administration. I keep on calling him Obama, but it's because he's basically a puppet of Obama. But the Biden administration had severe inflation, 7-9%, and then it started going down. But when someone says, well, the inflation is controlled, the inflation rate is controlled. The absolute price of eggs and milk and groceries and energy and housing is not relative to the income level increases of individuals. And that's the key point. And so you have to have below trend inflation to be able to have the economy grow into it. So that means to me that you need to actually keep rates at or even slightly increase rates to have a price pressure to have a signal in the market to bring prices down. Because some of this price increase are companies that are trying to pass on costs to their customers for higher profitability. You'll notice that these companies that are traded on the market, they're trying to raise their revenues, right, through this inflated cost. All right. Well, and then that's trickling down to an increased net income. Well, so they're not increasing their prices 100% to the cost of their costs for inventory or materials to make their products, but they're also buffering in additional costs that the consumer is trying to absorb. Well, the best way to do this is to raise rates and slow down the demand of those goods. And then what will happen is those companies that are adding to the real cost of their good will push them down to reduce that buffer. You do that by keeping the rates where they're at or increasing them slightly, not lowering them. We need a few data points below trend, below the 2% target, before we should be lowering rates. So I think that the Federal Reserve, if they start to cut rates, they're cutting rates too early. All right. Because the price pressure is too much on the consumer in absolute dollar terms. Stop thinking about this as like, well, it's 2.5 or it's 3% inflation compared to 7 or 9. Well, that's an improvement, but 7 and 9 was so bad that the absolute cost of the good is too problematic for the average consumer, and it needs to go down. Well, the only way to bring it down is force it down, raise the interest rates, or keep the rates high, and then these businesses will start getting the signal and then start cutting the costs and reducing their buffer. Because what's really happening in the stock market, and it can go higher, and I still have a target at the end of the year of 5,800 for the S&P 500 or even 6,000. So a lot of people are saying, oh, it's going to crash, it's going to crash. I'm not so sure about that. There's a very strong support level at 5,000, and there's a very strong support level at 4,800 and 800. So, this 4,800 support level and this 5,000 support level is so strong that I don't believe that there's going to be at least unless there's new information that comes out that the deterioration of the market is really bad. But I don't think that's the case. So I think that there's more percentage of it moving upward. But you can have an uptrending market, still have a subpar economy, right, for a while. There's kind of like this decoupling. And so the point that I'm making is that the companies' market cap, their earnings multiple in the stock market is too high. It needs to come down. When you see that kind of signal, the Federal Reserve is supposed to raise rates, not lower, to get the stock market more in line with the economy and to bring prices down. So what is giving the analysts the signal to raise expectations for these companies and to keep those multiples high is because of this price increase that these companies have put on their goods and services. Well, if they start reducing that, their revenues are going to go down, and then the analysts are going to start to downgrade them, and then the multiples, their price multiples for equities will become more reasonable. It's too bubbly. The Federal Reserve, if they cut rates, is going to hurt the economy because it's going to just send it's going to send extra money into the market and go up. This is another reason why I think it's going to go up to 6,000, not crash. All right. But from just a healthy market point of view, healthy economy point of view, it is important to keep the rates where they're at, and we need a few data points, like 3 or 4, where the inflation rate is below target, not above target, below target. Then start slowly bringing the rate down. If you see the signal that the stock market multiples are starting to come down to a more reasonable level, there is an irrational exuberance that is starting to happen in the market. But that can go on for a while. All right. I'd be concerned once the S&P 500 hits 5,800 or 6,000. Then you have to reevaluate, and it might be time to take some money off the, take some money out of the market and just put it into some sort of cash vehicle. But I think that the Federal Reserve is making a mistake on this. I really do. It's about two things. The market's multiple is too high for many of the companies that are part of the S&P 500, and the absolute dollars for goods and services are too high because of this 9 and 7% inflation that we had to go through during the Biden administration. It's going to take a while for the economy to grow into it, and people's incomes start to go up. All right. And we need to have 3 or 4 data points showing below trend inflation. That's below 2%. And then things can be where housing and goods and groceries and all these are more affordable. That's the way I would play it. But the Federal Reserve is not going to do that. They're going to do the wrong thing, and they're going to probably lower rates in September or October. I think September is their Jackson Hole meeting, and that's probably when they're going to start signaling that they're going to lower rates. So, and what will happen then, this is the hot money. There's going to be money they're going to cut the rates, right? And so they're putting money into the market. The Federal Reserve is putting money into the market, and that's going to bring up equities. And it's going to add fuel to an already high multiple for the S&P 500. This is problematic. And then the analysts will go, well, the stock for Apple should be even higher. And it's adding fuel to the fire. And then they're going to, the ones that are running these companies are going to try to increase sales and profit to be able to justify a higher multiple. That's how it works. And that's going to show an inflationary pressure. And we're going to see in the long run that them cutting rates too early is actually going to be inflationary. That's the stance that I have. Now, there are going to be people out there that go, you need to cut rates now to be able to help with the commercial and the residential sales. Yeah. But it's not helping the consumer that's buying. It's helping the seller. Now, people would say a lower rate would help the buyer. Well, yes, but the thing is that the buyer would be better off waiting and letting prices drop more so it's more affordable. Housing in many areas of the country is unaffordable, especially for people that are trying to do a first purchase, home buy. So we need a little bit more below trend inflation. We need to have absolute prices to go down and stop worrying about what's the differential between last quarter and this quarter, or last month and this month for inflation rate. No, what's the absolute price of eggs last month compared to this month? That's what you need to be looking at and comparing it what it was like 2 years ago. And then take an example, a data point pre-COVID, and then 2 years before that. So let's say 2018 egg price, and look at it in 2016 and look at the difference. When you see this, you're going to see that this inflationary push that happened during the Biden administration is still in the prices of goods and services relative to the purchasing power of individuals. The purchasing power of individuals had not grown that much. So the economy is less robust. This is part of the reason why, again, another data point that came out is that the unemployment rate went up. But it's still below the normal unemployment rate. The normal unemployment rate is 5 to 6%, depending on which economist you talk to. But let's just use the number 5%. We've been below normal unemployment rate for years. That's a signal that the economy is too hot. When you have inflation above the 2% target, that's also, repeatedly, that's also a signal that the economy is too hot. And the last signal to take a look at is the multiples in the stock market. They're too high. So when you have the multiples too high, you have the unemployment rate too low, below natural unemployment, and you have inflation running to above 2% repeatedly for months and quarters and even years. That's a signal, that's a very strong indication that the market is too hot and the Federal Reserve needs to come in and intervene. The Federal Reserve intervenes in a overheated market by raising rates, not lowering rates. The Federal Reserve is making a big mistake here by signaling that they're going to lower rates. The market multiple in the stock market's too high, and the unemployment rate is below natural unemployment. It's only at 4.3%. That's still low. The market, the economy is too hot. There's too much fluff in it, and it needs to kind of come back down to a more stable level. So that's my take on it. Please go to my store, the-studio-reykjavik.com, and get the omega-3. This is very important to take to help with your cardiovascular health. This will help with your lipid profile by lowering LDL, increase HDL, and omega-3 helps to prevent the stickiness of red blood cells. Magnesium and zinc helps to boost up your immune system. Really important to take every day, but if you're sick, take a double dose. Vitamin C, take every day. It helps with your skin and your immune system. If you're not feeling well, take a double dose. Drink plenty of water. Resveratrol helps to get rid of senescent cells. It's an antioxidant, and it's part of an anti-aging protocol. This is synergistic with C60 and some of the other supplements that I offer on my store. So please go to the store and get the resveratrol, the-studio-reykjavik.com. Vitamin B complex, really important for energy and cellular metabolism. The first 5 B vitamins are really important for your mitochondria. With good mitochondrial health, you're going to be able to have ATP. With ATP, you're going to have more energy, and more energy means better cellular health, faster thinking. You're going to be able to move around a lot. A big part of aging is the health of the cell and the health of the mitochondria. They decline when you get older, and they decline faster going from the 6th to the 7th or 8th decade of your life. It's important to boost up that mitochondria, the health of that mitochondria. And through that energy production, the ATP energy production of the mitochondria, you're going to be now healing the tissues and those cells. And over time, there's a compound effect, and you slow down the aging process and reverse some of it. So it's really important to take B complex vitamins. In addition, taking B complex vitamins will help with blood, right? And also, because it's going to prevent the macrocytic anemia. And also, it's important for neuronal health, neural health, and health with the spinal cord. So it's really important, really, really important to take B vitamins, especially when you get older. And olive leaf extract. It boosts up your immune system, and it also helps with the cardiovascular health. So you take this every day. This is a new product on my store, the-studio-reykjavik.com. How does it work? It boosts up your immune system, right, by bringing down inflammation, right? And then, like I said, you bring down those pro-inflammatory cytokines and you bring down that chronic inflammation, you're going to have your body heal faster. And it's not having to constantly fight this chronic inflammation. So you want to bring that down. So olive leaf extract does that. So it boosts up your immune system, and it helps with LDL and HDL levels. So it improves your lipid profile. So please go to the store and get the olive leaf extract. It's a very high quality product. So let's continue with Gouldsby.
Dropped precipitously. The unemployment rate shoots up more than anticipated. Everyone wants to know, did the Fed make a mistake by not cutting rates on Wednesday?
Well, look, you know, I'm not going to get myself in trouble and talk about what people's thinking are from the meeting. You're going to have to wait for the transcript to come out to see what was on people's mind. I've been saying to you, Mike, for a long time and publicly, that we never want to overreact to any 1 month's numbers. And if you back up to the last half of 2023, you know that the market said maybe there would be 7 cuts for the year. And then when a month would come in, then that 7 would drop to 3. Then there was a group saying maybe there will be an increase in rates. The job of the central bank is to figure out the through line and to move in a steady way. I've been warning that we are tight, we are restrictive. The real Fed funds rate is as high as it's been in decades. And as inflation falls, that gets tighter. If we stay restrictive for too long, we're going to have to think about the employment side of the mandate. And if you look here, if you take this summary,
the employment side of the mandate is below trend. We have record employment. The unemployment rate is too low. It's not at its natural level. It's too hot. To bring down the inflation, you have to bring up the unemployment. So they're all worried at 4.3%. It has to actually go up to 6 or 7%.
The statement of economic projections in the SEP, the neutral rate of inflation, the long-term rate of inflation and unemployment, say that people think full employment is about 4.1%.
This bullcrap.
So if unemployment is going to go up higher.
Why is basic economics, right? The number is 5%, maybe 5.5%. But it's they're trying to, if you notice the administrations, what they're trying to do is get the Federal Reserve to lower the bar for the benefit of politics. And this is the problem with Keynesians, is that they play games with economic numbers to have the Federal Reserve benefit the politics of the time, and not the economy at the time. By bringing the natural rate of unemployment lower, what that's going to do is increase the chances of a hot economy. And they also want to increase the target for inflation. And by doing that, you're increasing the chances of more and more persistent inflation. This is a move. By moving these numbers around is a Keynesian way to placate to politicians. He's wrong. He's totally wrong on this.
Then the neutral rate, that is exactly the kind of pinching on the other side of the mandate that the law says the Fed has to think about, respond to.
Well, you've been talking about a rate cut, yet you voted to keep rates unchanged. Why did you do that? And now do you think maybe you are behind the curve?
Well, look, like I say, I'm not going to get into talking about the secret discussion. You got to wait for the minutes and the transcript to come out. I was a seat filler at the Oscars. That's really Cleveland's seat. I was there for one meeting. The committee acts on the through line of the data, and the through line of the data, you should not change what you think the through line is based on 1 month's number. But and the overall, you know that I believe that we are restrictive. I think that I've been saying for months that what we wanted to see was improvement on inflation, and especially improvement in the components like housing and services. And we've been seeing that. And that the longer we were restrictive, we're going to have to start.
Goolsby, the inflation rate is still above target. Why cut? It's not below target. It's above target. Eggs are still expensive. Milk is still expensive. Until it's not so expensive, we need to start thinking that maybe the Federal Reserve needs to be contractionary.
About the employment side of the mandate.
Well, you've heard what the banks, economists, and traders are saying today. Should the next move in September be a 50 basis point cut? And what do you think about JP Morgan proposing from a risk management perspective, there's a strong case to act before September 18th?
Look, Paul Volcker, my old mentor and friend, used to always say, our job is to act and their job is to react. And let's not get the order mixed up on that. I fully understand why markets want to jump. If they get one scrap of information or they see one thing, they want to conclude a trend out of one data point. And I would just caution us, if we had acted at the end of 2023, based on a couple of observations, then these same people would have said, but look, inflation went back up in the first quarter. So that was a mistake. I think the most important thing is to look at the through line. What will determine the action is we don't want to tie our hands now. We're going to get a lot of information between now and the next meeting. And what will determine the size or if there is action at all will be the conditions. And that's the way it should be. That's, as I always say, the data dogs, there's a time for walking, there's a time for sniffing. The sniffing time is when there's a lot of uncertainty and you don't know what's what. Once you get the through line, that's the time for walking.
What exactly would it take to see a cut before that September meeting?
I'm not going to get into speculative bit about that. The FOMC acts in a consensus manner. We have deliberation and debate, and we vote on things. And I try to bring the through line mentality of don't take 1 month's number, look at what the trends are. And to me, the trends show inflation coming down across the board multiple months in a row. They show the labor market cooling. What we want is for the labor market to get into good balance, sort of the full employment natural rate. If we're not stopping at that, and we're not neutral, and we're going to have to be thinking about the employment side of the mandate.
It's not just about the next cut. It's also about the path forward from here. For the people that think that you might get multiple half-point rate cuts through September, through November, through December.
Do not lower the rate until the unemployment rate is above 5%.
Them in terms of what to expect for the entirety of the path going into next year.
Look, I don't like tying our hands even for the next meeting, so I certainly don't want to commit ourselves to what's going to be the rate path 5-7 meetings from now. With all of that said, just look at the statement of economic projections, and you can see that as a committee of the individuals have believed that the conditions will be appropriate to have multiple rate cuts with the unemployment getting into better balance and with inflation coming down to target, but even at a run rate that's a little higher than what we've seen in the last couple of months. So it's not any secret. The Fed's been pretty vocal about here's what the reaction function is, and expecting, as is historically true, when conditions warrant a cut, they tend not to be one individual cut. The SCP shows that the median dot of the dot plot has multiple cuts over the next year.
How weak is the U.S. economy overall? I want to point out something that your governor, J.B. Pritzker, the governor of Illinois, said just 2 days ago. Interest rates are holding companies back from making the investments that are necessary. All these companies are companies that are on a generally upward trajectory over the last decade, but are having a hard time in the moment because of some of the challenges the Federal Reserve has brought.
I mean, in a way, that's a description of monetary policy. That sounds like he's saying policy is restrictive, and I agree with him. When the real federal funds rate, that is the Fed funds rate minus inflation, that's as high as it's been in a very long time. And that's the highest it's been over this cycle as inflation comes down. We set
unemployment rate is too low. Inflation rate is too high. That means that you have a hot economy. This concept is the economy, is the economy weak or strong? It's that those metrics to define what is strong and what is weak is based on that number. Unemployment is low. It's too low. It's below natural unemployment rate. The inflation is too high. It's above target. The economy needs to be managed through higher interest rates to slow it down and signal the market to bring down these high multiples, or people are going to start losing money when the market crashes. He's playing politics at the Federal Reserve. He's trying to adjust the margins of the target rate, the target for inflation and unemployment for political means. He's saying that the Federal Reserve is too restrictive. If it was too restrictive, why do we still have inflation? Why is it still above trend? If it's too restrictive, why is unemployment rate too low? It's not too restrictive. It's not restrictive enough. Or you can say that when the Federal Reserve was acting, it wasn't acting aggressive enough. They should have increased rates much higher at a faster rate to be able to signal to the market. And to prove my point, about a year ago or a year and a half ago, a lot of people were saying that, and even the Federal Reserve was saying that there was going to be pain in the market, for the employment because of the raising of the rates, but they didn't raise it fast enough. And because they didn't raise it fast enough, they're now behind the curve. This thing is, the market, the economy is running slightly too hot. But a lot of people would say they feel that the economy isn't that good. Well, that's true because of inflation. And you have that inflationary signal because the economy is too hot, because the Federal Reserve is not restrictive enough.
A year ago, at a time when conditions were very different than they are now. And you should be tightening by choice, not by accident. You shouldn't back yourself into tightening. What we need to do is take the through line on inflation and unemployment, and that's what should determine our policy. I don't want to argue about the words, how good or how weak is the economy. Well, the numbers are the numbers. We've seen GDP growing around trend. We had one weaker than expected GDP growth number at the beginning of the year. Then we had a stronger than expected in the second quarter. And so we're growing.
So this is an important point that I'm
down.
making. Equities. This is an important point here. Equities multiple is too high. The GDP is just at about trend. All right. But you have record employment. You have a very low unemployment rate. The GDP should be higher. The reason why it's not higher is because of the inflationary pressure. You got to solve the inflationary pressure, and then things will get back to normal. And the only way to bring down inflation is to raise rates aggressively.
The strongest thing in the economy has been the job market. The weakest thing in the economy has been the inflation. Both of those are converging back to, let's call it normal or what it was pre-pandemic. And our absolute goal now is we want to settle at something like full employment, not blow through normal and deteriorate.
Well, I think the major thing that people want to know going forward is, now you mentioned all the data coming up. What are you going to be looking at? What are you going to base your interest rate decisions on?
You just said.
I mean, for the dual mandate comes to us by law. The law says the primary things we got to look at are inflation and the job market, and are we maximizing employment? So those are going to be the big two kahunas as we go forward. But it is still an economy with cross currents, where you got some things that remain quite strong by historical terms, and other things that have deteriorated. So if you look at credit card delinquencies or small business defaults, those have been rising, and they have moved into what I call warning sign stage. So I'm going to be looking at what Chair Powell calls the totality of the data, not just the monthly PCE inflation and jobs reports, but the PCE inflation and the jobs reports are the big two for sure by law.
On Bloomberg Television and Radio, I am Shanali Bassett. Joining us now is Bloomberg's Michael McKee.
Okay, so that is the Chicago Fed head, Goolsbee, on how he thinks that the market, or at least the Federal Reserve, is too restrictive, and I think they're not restrictive enough. But please go to my store, the-studio-reykjavik.com, and get the health supplements that I offer to help to boost up your immune system, slow down the aging process, and get your body in a condition where it has more vitality, more energy. If you follow my lead on this, you're going to slow down the aging process and boost up your immune system. Thank you for listening, and have a nice day.